what is private debt? And I suppose having moved through that economic background, we move our discussion to the private debt side of things. And really, with rates being at zero or very low since 2008 in Australia and globally, and by that I mean the TAMIM investment team, myself and the people that work alongside me, really struggled with the idea of allocating to bonds to get our fixed income exposure. We knew that somewhere along the cycle we were going to face a situation, and it took a lot longer than we thought, maybe in terms of it happening. But eventually in 2022, you saw a massive spike in inflation, and obviously interest rates moved up dramatically from then. Now, anyone that understands a little bit about fixed income or fixed interest securities will know that when interest rates go up like that, the face value of those bonds decrease, and you potentially suffer or can suffer capital losses. So we were staying as far away as we could from bonds, whether they were government bonds or even corporate bonds, for a long period of time, and really trying to find a place in our portfolios where we could allocate a fixed income exposure. And that really got us looking at private debt as an interesting alternative. We really liked what we saw, and we moved ahead with that. So what do we mean by private debt? Well, the first point I just want to make to you is quite often you're going to hear the terms private debt or private credit, and they seem to be used quite interchangeably. There's a slight difference in the definitions, but arguably for the purposes of this presentation today, we'll talk about private debt. So today in Australia, we think that private debt is considered to be a mainstream investment asset. In fact, today's webinar in terms of registrations was as popular as our Australian equity webinars. And to give you a bit of disclosure, our Australian equity webinars are normally exceptionally well attended. We can get anywhere from 400 to 500 people coming to that. So while we probably haven't hit 400 to 500 in the private debt conversation today, we're pretty close to those types of numbers. So there's obviously a lot of interest in the space, and everyone we're talking to when we were getting out into the marketplace, from family offices to mums and dads, are investing in private debt in some way. So what exactly is private debt? Effectively, it's describing something, usually money, which is owed by one particular group or person to another particular group or person. Basically, it's a transaction where a lender provides a loan to a borrower, and those loans are non-bank loans, which means that the lending party is not a bank. Importantly, that doesn't make these loans more risky, as most people would potentially believe. And what we found is that actually the banks have stayed away from the space because they've tended to be much more focused on their residential home loan lending businesses. Also, these types of loans have tended to be smaller and maybe a little bit more complicated. So within the banking environment, where they have fairly rigid guidelines and checklists that they have to follow, it just becomes more difficult for them to manage it. They're staying away in most instances as a result of them being more complicated and less profitable to operate for a bank, rather than operating that residential home loan business. Private debt, in terms of our conversation, has a number of characteristics that make it really interesting and a strong candidate for investment and inclusion in investment portfolios. The reasons or the characteristics are as follows from our perspective. The loans we see are typically individual and unique, and as a result of this, they can be tailored to the benefit of the lender from a security of capital perspective. This is normally done through underlying collateral or security, so we tend to be secured in the loans that we write. And also they can be protected by the provision of covenants or safeguards inside of lending agreements to the lender's benefit. Assets generally provided as security are hard assets, and in Australia, this collateral quite often tends to be in the form of property. Sometimes you'll see business assets or otherwise even business cash flows being offered as collateral. The loans can be structured to sit pretty high up in the capital stack, and are quite often senior secured. So that means they're sitting at the top end of the capital stack, and equity, which is generally quite a common investment asset class for us, will sit at the bottom of that capital stack, with mezzanine type loans sitting somewhere in the middle of all of that. Loans are often also accompanied by personal guarantees from borrowers. The one downside that we do talk about within private debt, and something to be quite aware of, is that the loans tend to be quite illiquid. And that does give us the benefit of better returns of them. So that's the upside of that. But the one thing to always remember is that you're typically going to hold these private debt investments for longer periods of time. And typically the underlying investments that we'll see out there are not necessarily easy to exit prior to their defined exit periods.